So hello guys, how you doing? Welcome to another video. So today I'll just talk about what normal term as liquidity engineering, or why it's termed that way, and I want to look at what the process of liquidity engineering actually is, right? So we all understand that when the market is moving, it forms highs and lows. Uh, Whatever current situation it's in, either in an uptrend, a downtrend, or in a consolidation, or whatever the case, the market is always forming highs and lows. Now, usually for price to give us these reversals at these highs and lows, there has to be liquidity taken out or liquidity that has to be created. Always for price to change direction, it requires liquidity at any one time to move to a different direction. So basically, when we speak about liquidity engineering, we're looking at specific forms of patterns that we use to identify areas where liquidity might have been formed. So for the case of how I trade particularly, we're going to take an example of an uptrend. Let's say price moving to the upside like this, forming higher highs and higher lows. Then somewhere within this sequence, price happens to break this pattern or the characteristics of the uptrend, right? Because we're forming higher highs and higher lows. And at this particular instant, we find price, instead of forming a higher low, price actually tends to form a lower low rate, tends to form a lower low somewhere around here. So when I have this incident, price has broken the characteristics that was going by, and I expect that price now going to move to the downside. Some people may call this a change of character, but personally, I call this liquidity engineering. Now, why I call it liquidity engineering, or why we take this to be liquidity engineering, is basically for this particular reason. Now, when price going to the upside, and it's trying to respect a trend line, right? We can set prices. We can set prices before we try to respect a trend line, and we expect that when it comes back to this point, some people will anticipate that price is going to actually tap this point, then continue to the upside. Some people are going to take some buys from this area and probably put their stop losses below here. Then we're going to have what we call the breakout traders, who may be waiting for price to break that resistance and take some buys here, probably with their stop losses below here. Now, those are two groups of other traders whom we anticipate that have been taken out, because remember, when price is grabbing liquidity, we're taking out stop losses, right? So we call it liquidity engineering because we're looking at the stop losses that might have been taken from other possible concepts. Now we have seen that we have trend line traders here who probably might have taken some buys at this point over here, and price breaks below this area here. Then we have the breakout traders who preferably might have taken some trades at this point over here, and then price violates that resistance new support level. Then we have a group of traders. I will not be so profiling, but of course, therefore, maybe wanting to trade this rate, probably having a premium and a discount area. They're having a fair value gap or an order block somewhere within this leg, and you find that price has taken them out as well. Right? So then we have, so there's some groups of traders whom we look at within this kind of pattern. Now, it's kind of like how liquidity engineering patterns are formed. Now we are seeing that we have over 3 groups of traders whose stop losses have been taken, right? Now, similarly, from our liquidity concepts, we know that at this high here, we had some orders up here. There are probably buy stop orders that were triggered for early buyers. Then price comes and takes them out. So liquidity has been engineered. That means that at this point, buy side liquidity has been taken out. Then at that same time, when you have buy side liquidity, we had sell side liquidity that has been taken out here. So we anticipate that there is a lot of orders that have been accumulated around this price action here. Now, similarly, at the same time, we understand that when price has been forming high highs and higher lows, then it forms a lower low. That means it's anticipating to change characteristics, what we call change of character. So you can start anticipating that price is going to what? To the downside, because now we expect price to come and give us a lower high, then form as a lower low, and then to can complete the change of character. So basically, this is what we call liquidity engineering. It's basically a pattern that just shows us where price change direction from and what might have happened when the orders are being taken out. So we just capitalize on the failures of different concepts at a particular point in price action. Now, always want to look for this kind of liquidity engineering patterns strictly at highs and lows. When I have a high or a low like this, I want to go and focus on this area here where price actually reversed from. Look for liquidity engineering, because only through liquidity engineering the price changes direction. It's going to first trap a lot of buyers and sellers in that same area there. This is what you call liquidity engineering. So it's a short video, I know, but I hope you can get something out of it. But basically, people have been asking what is liquidity engineering, why do people consider it? This is why you consider liquidity engineering. And as well, we don't take a trade directly from here. The best trade you'll take is on this second leg here. So when price comes, gives you a higher high, then the lower low, right? Then it comes, you want it to first continue and form the second lower low. Then you can come and look for your trade within this area to go down. Now, the reason behind that is actually pretty much very, very simple. We can have scenarios whereby price will come, then forms this lower low, then price just continues to the upside. Then of course, you'll hear some people say that this is an inducement, then they probably had an order block here. Yeah, so there are these scenarios like this that always happen. So from pure price action, you know that when you're confirming a trend, we have what you call the ABCD pattern, whereby you want price to give you a low, give you something of this kind. Then you have probably an A here, you have an A area here, then you have a B, then this will be your B, then this will be your C, then this will be your D, right? So ABC, they have three structure points, the same direction. Then this will be your entry. Then you can draw your trend line there. This is how you confirm a trend from the price action. Those who have read those books, beginner books as well. So basically, that's why this is a confirmed change of character. For guys who don't know it, some people look at it as the silver bullet pattern. Of course, you don't consider time. The confirmed change of character is this. So I have this. Now this is a market structure change. It's not a change of character yet, because characteristics are not yet fully aligned in the same direction. I know many videos I mean show you that this is a change of character, but this is just a market structure change. So when price comes and does this, the reason to take this because I'm having 1, 2, 3, then 4 structure points the same direction. So now here I can know that we have changed characteristics to the downside, and I can be able to take my trade off of that or of a PDRA or an order block, whatever is there. Now this is a confirmed change of character. It's a mistake that many people, actually even many mentors do not know actually. That's the reality, and I've seen portrayed it wrongly a lot, and they get banned a lot. So I hope this was insightful. Until next time.